Hi, I'm Jerry's Life, Tricio, and today I'm joined by John Calverley, Tricio's chief economist, and we're going to talk about economics for investment. We just released it this week for Q3 2025. Now, for those of you who aren't familiar with it, FE is our flagship publication, comes out 4 times a year, and in it, we try to give the overview of what we're looking for over the next quarter, 2 quarters, 1 year to 3 years in terms of our investment outlook and in terms of where we are in the economic cycle. The global outlook is that markets are rising despite policy worries. But the focus this quarter is on what's driving US yields. John, over to you.
In terms of the focus, we do a focus in the FE every quarter. And this time we looked at this question of why are US bond yields holding up? And indeed, why have they actually risen during the period that the Fed was cutting rates from September last year? And we look at various possible reasons for that. And one reason you can see on your screen, that the possibility that simply bond yields are going back to normal. We had this period of US 10-year yields down at 2%, even 1%. And now they're back up to the sort of 4 to 5% range, which is where they were before the global financial crisis. And that's also a level that people think makes a bit of sense if you think in terms of sort of 2% growth, 2% inflation, something like that, then you'd expect the bond yield to be about that same level. And behind that, clearly the term premium has risen. So people are now demanding a higher bond yield relative to what they actually expect for Fed funds rate on an ongoing basis over 10 years. And that, I think, is because of fears of inflation. We've just lived through this inflation boost, nearly 10%. And the fear is that it could come back in some way. And alongside that, and we talk quite a bit about this in the main part of FE, is the Big Beautiful Bill Act, which is really a huge thing. But one of its implications is that the US government is going to be borrowing a lot of money over the next few years. And that obviously has to be financed, and that tends to drive yields higher. So that's our thinking then, is that the normal level for 10-year yield now, in the absence of a recession, is going to be something like 4 to 5%, maybe a bit under 4 at times. But you shouldn't expect it to go back to the kind of 2 to 3% range that we saw in the 2010s.
All right, John. So basically laying out the path for US yields to be higher for longer. Is that correct?
Yes, and that's true even if the Fed cuts a little bit. I think the Fed most likely will cut a little bit over the next year, possibly not as much as the markets expect. Obviously, it will depend on the strength of the economy, but also on the path of inflation. The path of inflation is another big question that we raised through the report. This last mile is indeed proving difficult in the US, but also in the UK, to a lesser extent, I think, in the Eurozone. Getting it down from 2.5% to 3% down to 2% is going to be tough, I think, in the absence of weak economies. And the US probably will weaken a bit in the next few months because of the tariffs. But actually, the Big Beautiful Bill provides a big stimulus. And so we can't be sure that the US economy is going to be that weak. And in that environment, it's not clear that inflation is going to drop all the way to 2%. So there's definitely a question mark over that.
That's fantastic. Thank you, John. And if anybody would like to read our Economics for Investment, please contact us directly at LinkedIn or in emails, or at info@tricio-advisors, that's advisors with an O.com. Thanks, John. Great catching up with you.
Okay, thanks, Jerry.